Good afternoon, everybody, and welcome back to the weekly market analysis for the week ending October 27th, 2023, and what an October it has been. I just want to take a moment to remind you to hit the like button and subscribe to this channel, where you can find all the videos that I post on a weekly basis, including the one from last week, where I explained that there could be a market crash coming. It was a pretty good analysis, in my opinion. And a lot of things have transpired, and one of the things we're going to talk about today is the extent to which what I talked about last week is going to continue or not. What are the odds of continued downside versus a bounce perhaps coming? So we'll talk about that in just a moment. You can also find me on Twitter at Mr. J. Thomason, and you can follow my free weekly newsletter, or I guess the first half of my newsletter is free every week, and that's befinanciallyfree.substack.com. And you can find the link to both my Twitter and my Substack in the description of this video below. One of the things that I talked about a number of things last week, and we'll just kind of take a step back and kind of size up where the markets are at. I just checked, and the markets, the S&P 500 is now up a little under 4% now on the year, after having been up something like 20% when we got to our little peak in July. One of the things that I talked about last week was a pending tide cross. I talked about this in my newsletter as well. We did get a tide cross this week. And just to kind of go back over the history of tide crosses. So we had a tide cross right around the time of the regional banking crisis. That obviously was much more of a fear-induced crash. And so I feel like that was a false signal, because that came right on the heels of a tide cross, a bullish tide cross that had come a few weeks earlier. We had a bearish cross that came in March and in April of 2022. Obviously, we had a huge bounce in price, so that I would say that it's possible that what we're seeing right here, what the price action we just had this week is similar to potentially what we had in March of 2022, where we came down, had a tide cross, and then bounced really hard into the end of March before rolling back over and recrossing to the downside. Before that tide cross that we had in March 2020, these are happening in March a lot, I guess, where this was obviously on the COVID crash, but of course this was disrupted by the Fed stepping in and injecting unprecedented amounts of liquidity. We had a tide cross, bearish tide cross, that took place in November of 2018, and of course the market had already fallen about 10% at that point, bounced, and then we fell another 10% before the pullback was over. What I think is really interesting is, let's see here. So we had two tide crosses in August 2015, January 2016. I was going to say it's pretty rare to have two meaningful bearish tide crosses that take place before a new all-time high takes place. But I guess that happened in 2015 and 2016. And if I go back a little bit further, bearish tide cross in 2010 and in 2011. Bearish tide cross in 2007 before the big bear market. So having said all of that, a bearish tide cross is not a good sign. Typically a bearish tide cross indicates that for the medium term the momentum will be to the downside, and typically the highest probability trades are to the downside. But of course, typically what you would want to do is, in bearish tide, wait for price to come back up towards the tide line. That's of course the tide strategy, one of the three strategies that I use pretty consistently in my trading. So we got that bearish tide cross. That's something that investors did not want to see. We followed up our lower low after a feeble bounce to start the week on Tuesday. We basically came down ever since then. Even the earnings beats that we got from a lot of the big tech names was not enough to hold the markets up, and so a lot of things are transpiring right now, which suggest that, I mean, when you have earnings beats like that and the market sells it off, that's an indication of the direction the market actually wants to go. So I think it's an ominous sign, and so I would put this one, strike this one towards potential further downside into the next week. And essentially the other equity indices are indicating the same thing. That the NASDAQ is the remaining, which by the way went up like 50% this year. The NASDAQ is the only index that we're waiting to get a bearish tide cross on still. There are multiple key support levels that could potentially hold price up, but this looks all but certain unless we get significant price action to the upside to delay that. Otherwise, the S&P has now joined the Russell and the Dow in making bearish tide crosses. The Dow has made a lower closing low than its regional banking crisis lows. The Russell, we talked about it last week, the Russell made a new closing low, and it just has continued to go to the downside. We haven't seen these levels on the Russell since, what is this, October of 2020. And we are below, if you notice, when we broke support, I didn't talk about this last week, but when we broke support, we actually came below our pre-COVID highs, which is pretty amazing to note. So the momentum suggests that next week could see further downside. What's another bearish argument that we could make? One thing that I look at, if you've paid attention to this channel, is I look at the percentage of stocks above their 50-day moving average. And today, on today's price action, we actually came for a time below the extreme 10 level, which is the bearish extreme, which has I talked about this on my videos a few weeks ago, has a 83% hit ratio or hit percentage. But it didn't close below 10, and so I think that's very interesting to note. And I've kind of gone back and I've tried to look at some of the history of this on the time series. There's not a lot of places where this basically ticks across intraday. Like here we have one in October 2018, where we actually did close, and we closed just above 10. We closed at 10.11, but we wicked below. And in this situation, price did bounce, but then we obviously, of course, ended up falling another 10% after that. In February of 2018, we wicked below on a swift collapse in asset markets. Couple of instances where it kind of comes below but doesn't, like we had it in September 15. So it does happen. Let's see, we've got another one in 2014. Yeah, so you see it happen occasionally. If this had closed actually below the 10, then I would have been looking potentially for a bounce. It's possible it could bounce. I'm not really certain on that. But that's another indicator that still shows that there is some room to come down. And just because it crosses 10 doesn't mean it's guaranteed to that S&P is guaranteed to bounce, because obviously it could go down further. The extreme lows you see back here in September 22 were down below 5, and the same thing in June of 22. So it could come down pretty significantly, and obviously that means that would mean asset markets were crashing considerably at that point. So that's something that we could look at. Another thing this week, the VVIX to VIX ratio. If I put up my tide indicator, got a tide cross on the week confirmed, and so now that joins the small cap to mega cap ratio and the Russell value to Russell growth ratios in bearish tide. And So that's a big deal. And what's left now is the possibility of getting a bearish tide cross in high beta, low beta. This is something I'm watching, and I was tweeting this earlier, that some of my indicators are doing things that have me actually even more worried for next week. And I'm not trying to be, dramatic or anything, but at this point, what I'm concerned about is getting a little bit of a bounce into next week to slow this tide cross, because then what that's ultimately going to mean is that price is rebounding and bouncing in such a way that that bounce could get sold. Because if you think about it, the high beta, low beta looks pretty similar to the S&P chart, right? So what I'm concerned about is that if price comes up, then it won't come up enough to cause the high beta, low beta ratio to protect itself from crossing to the downside, and then price will, like the ratio will roll over. Right as and that'll be a signifier that the S&P is going to continue to roll over. So that would look like, let me see if I can get this up here. That would look something like this, bouncing up basically into that support line or into that resistance line, and then collapsing down from there. So that could happen. I don't really like kind of where that has closed for today, but that is something that I think is something to be concerned about. The VIX closing the week above 20. We popped above last Thursday, stayed above last Friday, sold it off for the first 2 days of the week, and then popped a couple of times. As long as the VIX stays above 20 and is upward trending, this week or last week we confirmed a VIX tide cross to the upside. So that's obviously something you want to be concerned about, because tide crosses to the upside on VIX suggest that there will be more volatility in the near to medium term. That's something to be concerned about as well. Bond market volatility also this week confirmed a bullish tide cross, and so if you're bearish, risk asset bulls should be concerned about bullish tide move index. Credit spreads have not yet crossed. Of course, we don't have updated data for today. We only have updated as of yesterday, and so it's entirely possible if this came up any higher that we could push this into a cross. But this looks likely to cross next week unless spreads collapse, and so that's obviously going to be the trifecta: credit spreads, the move index, which is bond volatility, and then equity volatility. If all three of those are bullish tide, that's obviously going to be not a good thing. So that would be another reason for continued bearish price action next week. Now, on the bullish side of things, why should we be at all bullish? And I don't mean bullish like to say that I'm bullish. Like somebody will watch this video and think, oh, he's bullish, that means he thinks stocks are going to go make all-time highs right now. That's not what that means. I mean, like on a short time frame, you could be bullish for a bounce. Like think back to what I said about stocks above their 50-day moving average. In this case, the difference between 1033 where it closed and the actual 10 level is almost negligible. So it's entirely possible that this could actually be a bullish indicator, that this would be a place to buy. And some of the price history here suggests that we could, in the near term, get a bounce up towards the midline and then come back down. If we even come back down, obviously nothing is certain. I don't want to talk uncertainties as if to say the markets are going to crash for sure, something like that. But just keeping the possibilities open. Another thing that's bullish is, or that's theoretically bullish, is that at least the S&P and the Russell are both oversold in terms of the RSI, their respective RSIs. If I open up the probable range model that I use, price on the S&P is at the very low end of its probable range. Same on the Russell. The NASDAQ basically almost touched it. And so that would be that could be indicative of price being a little bit overextended to the downside, and obviously that would mean a bounce could be coming. On the Nasdaq, one of the things that could be cause for hope is that we're still above pretty significant support levels, kind of closing at one support level right now. But we've also got this what maybe you could say it's a bull flag. Obviously, like, it doesn't matter what kind of chart pattern you want to use or chart formation you want to use. If it breaks down, it's obviously going to be bearish, but it could also bounce pretty hard up to the top of the flag pattern to the upper trend line. And that's from where we closed today. To bounce up is a 6% move. So obviously that's something that could happen on the bullish side as well. I would say, going back to the VIX, as far as bullish arguments go, one of the things that got pointed out, I forget who pointed it out on Twitter, but the last 2 weeks, there have been VIX pops on Friday that have been sold on Monday. So Friday the 20th, we popped up. Monday the 23rd, earlier this week, we got knocked down pretty hard, down 6.18%. The Friday before that, Friday the 13th, the VIX jumped 15%, and then the following Monday dropped almost 11%. And obviously, like, if you go back to S&P, then on Monday and into Tuesday, earlier this week, we jumped up pretty substantially, and then the previous week before that, we were up a whole percentage point after Friday's down day, which was down about 0.5%. So all that is to say that that has happened a couple of weeks in a row. It could be a third week in a row. That could be a bullish argument as well. The only thing, there are some other things that I would call to your attention. I don't have the charts ready right now, so I'm not going to show them. But basically, positioning in the S&P 500 got more bullish, actually, interestingly, during according to the latest CFTC report, which is worrisome to me, because what that suggests to me is that, I was hearing a lot on CNBC, and I guess I'm going back to some bearish arguments here. I had been hearing for a couple of weeks on CNBC that 4,200 was the strong support level, and that was the place to go long. And I had been hearing a lot about all these people wanting to buy the dip, and that was kind of concerning. So I think that the fact that everyone was kind of asking for 4,200 either told me that we were not going to make 4,200 or that we were going to blow through 4,200. And so it's kind of funny, because I've been hearing it basically since the beginning of September, or mid-September. So we came down and didn't get to 4,200 and bounced. And I think a lot of people chased this one. And then we started to come down, and I think a lot of people tried to buy this dip, and then it got sold pretty heavily. Definitely from the earnings they were trying to buy, I think. So the positioning got longer rather than shorter. So I think that's a knock against bullish price action next week. And then I also, like I said, I don't have the chart up, but sentiment, according to the sentiment surveys, sentiment got more bearish. So this is a point towards, this is one argument in favor of the bulls here, that sentiment got very, very bearish. And it's the bearish sentiment is in like the 85th percentile, and the bull-bear spread, the difference between bulls and bears, is in like the 14th percentile or 15th percentile. So it's getting down there to pretty extreme levels. But the problem that I have with that is that at this particular juncture, the sentiment survey is conflicting with the positioning that you're seeing according to the CFTC data. And so in that case, when you've got like things like the VIX and the MOVE index in bullish tide, and credit spreads going up, and VVIX to VIX crossing down, and you've got breadth deteriorating, but not to extremes. Like, we're not even to extremes on the stocks above their 200-day moving averages yet. And so, like I said, there's a lot of room for this to collapse even further. So the way that I see this is like, today the NASDAQ is up. It probably could have been down, but Amazon earnings caused a big pop in price, and I think Intel as well. So all of those things are, the NASDAQ could be in a much worse situation. So I think if I'm looking at this, if you're already in short trades, then this would be a situation where, at the first sign of life in the markets, whether it be on the NASDAQ, on the S&P, on the Russell, whatever, at the first sign of life, it might be a good idea to lighten up. But I think it's safe to stay with the trend here, and I suspect that price is actually going to continue to the downside. I think we could get a bounce on Monday because there's been a lot of fear and things are pretty oversold here. But I don't think that bounce is going to last, and I still have kind of the same level of caution now as I did last week. Although I would argue that the risk to reward of being bearish at this particular point is not as good as it was last Friday, when a lot more of the signals were lining up as far as the crash signals. So the other thing I wanted to just briefly mention, I want to go to gold because I went on a bit of a tirade last week about gold's price action, and obviously it's turning, like we had more geopolitical news today, which led to another spike in gold. And of course, all the gold bugs are really loud. I mean, this almost looks exactly like the same price action from post SVB, and it looks very similar to the price action that we had going into the Russia-Ukraine war. So I still stand by what I said, generally speaking, as far as that there's not really a lot fundamentally in this gold move. It's more of a it was oversold, positioned very bearish, and we got a geopolitical fear event that helped to spike it out of that condition. So I mean, how long can this last? Can gold go up? I would concede at this point that all-time highs are much more of a possibility right now than they were, in my opinion, back when I made the call that we would not see an all-time high in 2023. Of course, you can never foresee these things, but I guess my point is that the involvement of the U.S. and kind of the what seems to be increasing tension means that there could potentially be more fire underneath this, more momentum underneath this this move to the upside. So I would concede that I have a lot less conviction in my call about gold not making an all-time high in 2023 now because of the way that things have transpired. I still think, like, if something changes or if there's de-escalation with the Israel-Hamas war, then I think that this will come off pretty hard and pretty fast. But outside of that, if the tensions continue and they increase, then definitely this definitely has the ability to make all-time highs in the near term. So we'll see what happens. But I think the other thing to associate with that is the moves in crude oil, because crude oil is not necessarily a geopolitical hedge like gold is, but it largely should, especially because the Middle East is involved, it largely should react very similarly, not exactly, but very similarly to gold, and yet it's not. And so here's a really, I've brought this up already, but here's a really good illustration of the power of oversold plus positioning plus news catalyst, which crude oil largely was not, did not experience, because crude oil, by the time the Israel-Gaza conflict happened, crude oil had already, unlike gold. So in the last few months before, like in 3 months, crude oil rose 40%, and the positioning was so uber bullish that, you know, it had started to reverse, and that's part of the reason why crude hasn't been able to maintain a lot of these price pops on the news, while gold over the same interval, you know, before, let's see, what did I just do on crude oil? If I go from, you know, the end of June to the end of September, so let me do that on gold. Go to, from the end of June, where are you? The end of June to the end of September, you know, gold is down, right? So not down that much, but it's down pretty extensively. And right before the geopolitical tensions happened, gold was down, you know, 5% or more in a span of, you know, 2 or 3 weeks. Or what was that? That was 2 weeks, or 1 week. I'm sorry, a little over 1 week. So again, it's a completely different scenario because you're factoring in the conditions of being oversold plus the bearish positioning, where you have basically the opposite situation in crude oil. It was overbought and was overpositioned bullish. And so in that situation, though, like, and this is the funny thing, in crude, the fundamental story is there. There's supply shortage. The SPR has been drained like crazy. There's still increased demand for energy despite the fact that energy prices are up. And it still is not enough to keep the market up as far as oil price goes. So it's an interesting dynamic at play. But anyway, that's I think where I'll stop. I still think that you need to be cautious going into next week. If you're short, be careful FOMOing into a short position, or be careful being too aggressive. Make sure that you are covering your bases and hedging that position if you're in a position. If you're itching to get long, stay on the sidelines, wait for confirmation to the upside before you just buy in, because there's plenty of room, plenty of money to be made if that's you. And otherwise, if you have no conviction and no certainty, then just stand on the sidelines and wait, because that is a position of power. So we'll stop there, and I'll see you guys next week. I hope you guys have a good weekend. See ya.